We have tracked the modern debt cycle from the foundations of the global housing market to the constraints placed on the individual borrower through student and auto loans. But the largest and arguably most toxic concentration of risk today lies not in the consumer sector, but deep within the balance sheets of corporations, the very companies whose stock you may own, whose pensions rely upon, and whose stability underpins the entire job market. We are talking about corporate debt, specifically the vast $4 trillion ocean of high-risk, high-yield securities known ominously as junk bonds. This debt is the fuel for many corporate operations, but it is also the invisible foundation, and that foundation is built upon sand. We are here to deliver a stark warning. The scale and poor quality of the current corporate debt load guarantee a market crash that will rival, and potentially exceed, the damage of 2008 or the 2000 tech bubble. The guaranteed nature of this impending crisis stems from a decade of financial malpractice, fueled by the same cheap money we've discussed before. When interest rates hovered near zero, corporations, even those with shaky finances, were incentivized to gorge on debt. They weren't borrowing to build new factories or hire more engineers. They were borrowing primarily to fund share buybacks, increase dividends, or acquire competitors at inflated prices. This era transformed many otherwise healthy companies into what economists call zombie firms, companies that generate just enough cash flow to service their interest payments, but not enough to pay down the principal debt itself. They survive only on the constant promise of refinancing. The total amount of this high-risk debt has swelled to unprecedented levels, making the corporate world extremely brittle. Now we introduce the decisive force, the maturity wall. This is the point where the crisis transitions from an abstract risk to an absolute certainty. The vast majority of the debt issued during the cheap money era was set on a fixed-term schedule, and in the coming years, specifically between 2025 and 2027, an unprecedented wave of hundreds of billions of dollars in corporate debt is scheduled to mature. This means these zombie firms must find new lenders to refinance their debt. The problem? They must now refinance at interest rates that are not 2% or 3%, but 6%, 8%, or even higher, reflecting the true cost of credit in a tightened monetary environment. The increased cost of servicing this debt will push thousands of these already fragile companies from zombie status directly into insolvency. They will be unable to pay the interest, unable to refinance the principal, and forced into mass default. This crisis is compounded by the dangerous cousin of the junk bond, the leveraged loan market, a $1.4 trillion market that is even more poorly regulated and risky. Leveraged loans are essentially bank loans to highly indebted companies, often with floating interest rates. These too are bundled into collateralized loan obligations, CLOs, and sold to institutions globally. When interest rates rise, the cost of servicing these floating rate loans immediately rockets, accelerating the default timeline for these companies. The failure of one company relying on both junk bonds and leveraged loans sends a cascading shockwave through the CLO and ABS markets, threatening the very institutions, banks, insurance companies, and pension funds that hold them. This is the mechanism by which the corporate bond market guarantees a market crash. The defaults deplete the liquidity of financial institutions, forcing them to sell healthy assets to cover losses, thereby triggering a generalized stock market panic. The final chilling difference from 2008 is the lack of systemic discipline. In 2008, the crisis was caused by a failure of underwriting quality. Today, the failure is one of unprecedented, acknowledged scale. Rating agencies, under pressure, have been lax in downgrading indebted companies, allowing low-quality debt to masquerade as investment-grade securities, a practice known as fallen angels. This ensures that when the true defaults begin, the market will suffer a double shock. First, from the default itself, and second, from the massive synchronized downgrade of corporate credit across the board. The ensuing rush for the exits will create a massive liquidity vacuum, turning a credit event into a full-blown financial collapse. This time the debt is so vast and the companies are so leveraged that central banks simply cannot print enough money to bail out the entire corporate sector without triggering hyperinflation. The corporate debt time bomb is ticking, and the fuse is the maturity wall approaching in the next few years. Understanding this risk is not a matter of market speculation. It is a matter of solvency and capital preservation. If this deep dive into the corporate debt structure provides you with the clarity needed to protect your investments and comprehend the final stage of the debt cycle, then please take a moment to subscribe. By subscribing, you join us in decoding the hidden architectures of finance, arming you with the intelligence required to navigate the guaranteed volatility ahead. We have systematically analyzed the biggest debts in the modern financial world. But there is one final, colossal, and entirely opaque corner of the system where risk is concentrated, hidden away from public scrutiny and regulatory stress tests. Join us next time for the last deep dive in this series. The insurance debt trap, the hidden risk that no one is stress testing. You will not want to miss this crucial examination of the final massive systemic threat.